Good evening. Wednesday night, March 4th, 2026. Tonight's focus extends beyond routine market fluctuations and daily price charts. While silver closed the session at $85, maintaining what traders describe as a V-shaped recovery and holding its established support level, the more significant development came out of Washington, D.C. Earlier today, President Trump announced that the United States Navy will begin escorting commercial oil tankers through the Strait of Hormuz. The mission is aimed at protecting global energy supplies from Iranian drone strikes linked to Operation Epic Fury. In addition to deploying naval forces, the administration confirmed that the U.S. government will provide taxpayer-backed financial insurance to shipping companies. That coverage would apply if tankers are struck while transiting the conflict zone. The announcement represents a substantial military and financial commitment. The United States currently carries a national debt of $34.3 trillion. Despite that figure, the government has pledged to deploy naval assets into an active combat region, while also underwriting potential maritime losses tied to ongoing hostilities. Meanwhile, in the commodities market, silver's price action reflected resilience. Attempts to push prices lower during the session did not succeed, and the metal closed the day still holding at $85. However, market analysts suggest that today's geopolitical decision could carry far broader economic implications than any single trading session. To understand the scale of today's announcement, it is important to examine the operational requirements involved in securing the Strait of Hormuz. This narrow waterway handles approximately 21 million barrels of oil per day, representing about 21% of global petroleum traffic. Protecting that volume of shipping in an active conflict zone would require a significant and sustained naval presence. According to defense cost estimates referenced in the report, a single carrier strike group, consisting of one aircraft carrier along with its escorting destroyers, cruisers, submarines, and support vessels, costs roughly $25 million per day to operate. That figure includes crew salaries, fuel, aircraft operations, maintenance, and munitions. However, securing the strait would require more than one carrier group. Military logistics assessments indicate that at least 3 to 4 carrier strike groups would need to remain stationed in the region at all times, with an additional 2 to 3 groups rotating in transit or undergoing maintenance to sustain long-term operations. At minimum, this translates into daily naval operating costs of approximately $75 to $100 million. Beyond naval deployments, the mission would also involve Aegis-equipped destroyers for missile defense, P-8 Poseidon surveillance aircraft, aerial refueling tankers, amphibious response units, and continuous rotational support to prevent personnel fatigue. In addition to military expenditures, the administration's pledge to provide financial insurance to commercial shippers introduces another significant cost layer. Maritime war risk insurance premiums for vessels transiting the strait during Operation Epic Fury have reportedly risen to between 5 and 7% of a tanker's total value per voyage. A modern Suezmax crude oil tanker is valued at approximately $60 to $80 million, placing current insurance costs at roughly $4 to $5 million per trip. With an estimated 50 to 60 tankers passing through the strait daily, underwriting those voyages could amount to roughly $200 million per day in insurance exposure alone. When combined with naval operations and additional military support functions, projected daily expenditures range from $300 to $400 million. Over the course of 1 year, that would total approximately $109.5 billion at the lower end of the estimate. If sustained for 2 years, costs could reach roughly $219 billion. A 3-year commitment would approach $328 billion, assuming no escalation beyond current projections. In response to questions about how the operation would be funded, the Treasury Secretary stated that the administration would work with Congress to ensure adequate appropriations. According to the report, this would involve issuing new Treasury bonds to finance the initiative. The report outlines a detailed mechanism through which this new spending could influence monetary conditions. If Congress authorizes emergency funding, estimated in the report at between $50 and $100 billion in initial appropriations, the Treasury would issue additional government bonds to raise the required capital. However, the bond market environment has shifted over the past 18 months. Foreign central banks, including China, have been net sellers of U.S. Treasuries, while domestic institutional investors have demanded higher yields. Should demand for newly issued bonds prove insufficient at affordable interest rates, the Federal Reserve could step in as a buyer of last resort by purchasing Treasury securities on the open market. When the Federal Reserve acquires government bonds, it credits the Treasury's account with newly created reserves. According to the explanation presented in the report, this process expands the money supply by creating new dollars that did not previously exist. The report defines inflation not as rising prices themselves, but as an expansion of the money supply, with price increases described as a consequence of that expansion. The analysis further compares the projected annual cost of approximately $100 billion for the naval operation with the estimated size of the global investment silver market. The total above-ground silver available for investment, including bars and coins held by investors, is estimated at roughly 2 to 2.5 billion ounces. At $85 per ounce, that places the market value near $212.5 billion. The report notes that printing $100 billion would represent nearly half of that estimated market capitalization. It also reviews current futures market data, stating that total COMEX silver inventories stand at approximately 285 million ounces, with about 35 million ounces classified as registered and available for delivery. At the same time, open interest in silver futures exceeds 170,000 contracts, representing approximately 850 million ounces of paper claims. This reflects a leverage ratio of roughly 24-to-1 between paper contracts and registered physical supply. The geopolitical backdrop also plays a central role. Operation Epic Fury is described as an escalation of the Israeli-Iranian proxy conflict that has intensified since late 2025. Iran is reported to be backing Houthi rebels in Yemen, Hezbollah in Lebanon, and Shia militias in Iraq, while Israel has conducted airstrikes inside Iranian territory. The United States, as Israel's primary military backer, is now committing naval forces to secure energy transit routes. At the same time, BRICS nations, Brazil, Russia, India, China, and South Africa, along with new 2024 members Saudi Arabia, the UAE, Egypt, and Iran, are pursuing alternative trade settlement systems. These efforts include gold accumulation, oil trade settlements in yuan and rubles, and initiatives designed to bypass the SWIFT financial network. The People's Bank of China added more than 200 tons of gold to its reserves in 2025. Russia has continued purchasing gold since 2014. India has opened a gold exchange in Mumbai, and Saudi Arabia has accepted yuan for oil sales to China. In summary, the United States has announced a large-scale naval deployment and financial guarantee program tied to protecting global energy shipments. Estimated costs range from hundreds of millions of dollars per day to well over $100 billion annually, depending on duration and scope. Funding is expected to come through congressional appropriations and additional bond issuance. Silver closed the day at $85, maintaining its support level. As policymakers move forward with this commitment, markets will continue to assess the fiscal, monetary, and geopolitical dimensions of this development.